So yes, guys, why does this every single 7 year cycle have a market crash that is very consistent as you're seeing right here? The first one you're seeing right here is the dot-com bubble right here. Massive 80% pullback. The second one, you have a 54% pullback around that housing market crisis. This was one of those exceptions. And right now, exactly as it started right here, it's starting to pull back exactly around that September timeframe. So every 7 years, guys, there's a thing called the Shmita. This is like a part 2 to the stock market crash video I made before. So as you can see right here, guys, every 7 years at this moment, we are seeing very consistent stock market crashes around these times, because these are the years where we have a balance on most of the markets in general, because as you can see right here, 80% pullback. So first, it starts out like a dead cat bounce scenario, as you can see right here. I'm gonna show you guys. This is a strategy that, in summary, I'm gonna show you guys how it works. You pull the from the top here to the bottom low right here, and then the strategy here is that after a massive pullback right here, the price will come back to where? To around that 0.5, which means 50% of this move, and around that 0.618 and that 0.65. And usually in the dead cat bounce scenario, the price would get rejected around that 0.5 and that around that 0.618, 0.65. And then if it can't hold this 0.236 and this 0.32, then it pulls back, and the low, this low has a pullback, and the low is gonna go lower than this one. And exactly as that September starts, you see that the NASDAQ is just pulling back by a lot. And exactly, you have one dead cat bounce scenario there. The second one, as you can see right here, started around here. As you can see, you will see that this strategy works very well. You pull it from here to here again. And again, guys, you're going to see, as I showed you before, pullback, rejection exactly at that 0.5. Then it can't handle and hold around that 0.236 and that 0.382. And the low is going to go lower than this one. And then you have that second dead cat bounce scenario. And then another one happened right here, guys. I'm going to show you guys. Happened right here. I'm going to show you from here. Here it happened, and boom. And the same thing over and over again. Look at that pullback, bounce around that 0.5 and that 0.618 and that 0.65, rejection, and then it can't handle those 0.236 and that's 0.382, and then another lower low than this one. That's very consistent. This was around that 9/11 supposedly incidents. So yeah, that was, this Shmita years, a random thing out of nowhere happens, a random thing which is not random because it's completely planned. It's part of the design. When these Shmita years, almost every single time happens during peaks on the markets. It doesn't fail, as you're seeing right here. You have this massive dot-com bubble thing going right here. And then, out of nowhere, exactly around that dead cat bounce scenario, oh no, 9/11, oh, and how convenient. And the same thing again, this was around that housing market crisis right here, around this 2007-2008 housing market crisis. Exactly. So the Shmita starts on September 7, and it ends the next year, September 7. So in this case, this Shmita year was around September 7, 2000 to September 7, 2001. And then the other one, which this one was, the first one right here was around that 80% pullback. Here you had the housing market crisis going here. And you see here exactly when it starts around that September 7, boom, pullback, dead cat bounce, and boom, massive pullback around that 54% pullback around that time. And Shmita means release. So usually when the Shmita ends, then you are going to expect that massive dumpage to the downside most of the times. And as you can see right here, the same thing happened. You see this dead cat bounce here going from here to here. And you see, wait, I'm gonna show you the first one. Okay, so dead cat bounces are very common during these Shmitas. So you're seeing here, this was the first one. You're seeing right here, the dead cat bounce, pullback, rejection around that 0.5, and that's 0.618, and that's 0.65. If you want to retrace, and then if it can't hold that 0.236, and that's 0.382, then it will create a lower low than this low right there. And you have the first one there, and in middle of that one, you see another one right here. So the second dead cat bounce scenario will be here. I'm gonna show you guys here. This will be the second one, and there. And this one managed to go even higher than the measurements I'm telling you, which I told you previously, which would be here. You have the pullback, rebound. It went all the way up to around the 0.786 Fibonacci retracement, and then got rejected, and then it couldn't handle that, couldn't hold this 0.236, and that's 0.382, and then created a lower low, which will be the dead cat bounce scenario again and again. Second one, and then after that one, then the market crash was over, and then bounce out of there with a double bottom scenario like this. Boom, 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 and let's go to the moon. So yeah, guys, so 2 dead cat bounces. So using the previous cycles right here, we can see that this market crisis wasn't that harsh, because when you come out of a look at this, guys, a massive uptrend, then you have an 80% pullback, recovery around here. Let's see here something, guys, and here it was a 54% because the massive pullback was already done right here, and then a rebound and another one to have more momentum to keep going to the upside. And then we go to this September 7, 2015 to this September 7, 2016. Wait, it was, no. We go to September 7, 2014 to September 7, 2015. So in this one, you can see that there wasn't any massive pullbacks. There were some pullbacks right here, but it wasn't that. The price mostly remained the same during those times. And why did that happen? Well, in summary, I would say based on the previous movements, when you have a massive uptrend, you have an 80% pullback, some recovery right here, another 54% pullback, and then we have the Shmita right here, then most likely this has enough momentum to keep going higher, because it already went down 2 harsh pullbacks. So it would make sense to this keep going higher. So that's the reasoning why I saw that this movement didn't perform that harshly. But during these times, the most affected markets were in the Japanese stock market during those times. So yeah, it still had its effect. It is on effect. So yeah, guys, so now we're going to this one, which will be the September 7, 2021 Shmita, and the September 7, 2022 Shmita right here. And as you can see right here, guys, this using the dead cat bounce scenario here. Look at this, guys. I'm gonna show you, and there. So this was the first dead cat bounce, as you can see right here, guys. I'm gonna show you here. Look at this, guys. Pullback, and got rejected around the 0.5, and then created a lower low right here, because it couldn't hold that 0.236, and that's 0.382. And boom, you got that first dead cat bounce scenario. 1, potentially there is 2 more left, but to be in the conservative side, it will be most likely another dead cat bounce scenario coming very soon, which would most likely be this one, because as you're seeing right here, pulling the Fibonacci retracement from this one right here to this one, at this moment, this is a potential, it's a second dead cat bounce scenario. You pull back, and now it's above that 0.5. It's heading to that 0.618 and that 0.65. And this is looking very similar to the housing market crisis dead cat bounce scenario, and almost in the same time frame. I'm gonna show you guys very quickly here. So you can see here, this one, first it did a dead cat bounce right here. Then it formed like this double bottom scenario, recovery, and then a pullback, another recovery around this time frame, around this August the time frame, to then start heading back lower around that second dead cat bounce scenario. Exactly the same thing is happening right here. Looking at the Nasdaq, you're seeing here, guys, I'm gonna delete this so you can see it again. And first dead cat bounce, boom. Then you have that double bottom, and now this will be potentially the second dead cat bounce scenario. At this moment, it is not confirmed yet, but according to what I'm seeing here and looking at the Shmitahs, the dead cat bounce scenario is very common during these times. And also the second thing is that the Federal Reserve is not printing money. So usually when markets go up, the Federal Reserve is printing money and also investing the money. And right now we have the opposite. The Fed is not printing money, and they're not investing their money. So that's how markets work. The markets are going to go up as soon as the Federal Reserve starts printing more money, because the whole market depends mostly with the Federal Reserve. That's how it's designed to be. And during these times, these Shmita years, how coincidental you see that the Federal Reserve starts not printing more money and then starts not investing during those times. It's very consistent. In other words, it's obvious. It's planned. That's why it keeps happening, because if it's a coincidence, it will happen 1 to 2 times maybe, and it will not be this consistent, which is it is that consistent because it's a planned thing. So this scenario, I'm anticipating from this time, from August 2022 to December 22, something big to happen worldwide, because that's what usually happens during these times. You see a big event out of nowhere, but hey, it's planned. It already shows it in the graphs. So the graphs are gonna show you what's really happening, okay? Most people don't know how to read graphs, and the graphs truly tell you what is most likely going to happen with the price, because it indicates it before it happens. And that's why news are gonna manipulate news and put emotional things based on the market out of nowhere. So these graphs are gonna show you what is most likely going to come. So a dead cat bounce scenario is mostly going to happen. Shmita time, I like to say that a Shmita time is going to happen, and this would be a fake out to the downside. So as you can see right here, guys, I drew this resistance right here, this white line, double resistance here, and now it's potentially going to break. It's breaking at this moment this resistance, and when it breaks this resistance, it usually retests this previous resistance, which will be the white line, as new support this time, and then go higher. But what I'm personally anticipating is that a breakout and then a pullback around that white line, and then it will try to hold that as support, but it will not hold that support and make a fake out to the downside. And so at this moment, using the Fibonacci retracement right here, this will be the dead cat bounce scenario. Okay, this, and here. Remember, guys, this can go all the way up to around 0.78 cents. This one. This 0.78 cents. So that price can do this all the way up here. That's the most I'm seeing as the upside, which will be around that $14,369 with 62 cents right there. That would be the very drastic relief if it's going to do that. But most of the times what happens is that it usually goes in between this 0.5 and this 0.618 and this 0.65, so that it is around here and here. So at this moment I'm anticipating this, maybe here rejection and start going like this, and boom, that's the move I'm anticipating. So yeah, guys, the Shmitah means release. It appears on the Bible. It's a 7-year cycle where it goes more than 100, more than 200 years. Usually it means resets. It's a reset, in other words. So in the biblical sense, in the Bible sense, you have the 7 years where the farmers have their crops they're working on the crops for 6 years, and then that 7th year, based on their belief, they go and take that year off, and the crops that are left behind, they must not touch it and leave it there. If animals want to touch it, they can touch it. If people want to grab those, they can grab those. So in the economical sense, what it means that it is a time where forgiveness for loans, it is applied. So for example, this whole market is based on debt. So in summary, when the US dollar goes up, the investments go down, and when the US dollar goes down, the investments go up. And during these years, the US dollar gains strength. It increases in its value, and when it increases in its value, then most of the investments are gonna go down. And that's the balance. That's like the yin yang effect in that case. And during those times, you have a lot of forgiveness. You have a lot of bankruptcy because of the markets. And when you see that the debt is being forgiven, then money is being removed from the system. And if money gets removed from the system, then there's less money, but there's a lot of demand. Less money, more demand, which means the value of that US dollar will go up. And if the US dollar goes up, then most investments are going to go down. That's the most that's a very good summary right there of how it works. That's almost all you need to know about this market. That's most of it, really. And so, okay, guys. So let's see. Based on previous history, if I have different scenarios going here. So for example, if this market crash is going to be exactly like the dot-com bubble right here, which will be an 80%, then this would be the move. 80% will take the price down around here, around, let's see here, and $3,050 right here, which it's very drastic, but it can happen. But I personally think that's not going to happen. But if it happens, that is the scenario. Okay, the second scenario I'm seeing here. So you're seeing this red lines over here. So this is a fractal. You see this? This is a fractal. So what it did is that I took this fractal. Fractal means previous exact price action. So I used the bars pattern right here from this top to here, and then I put this over here like this, and boom, and then this red lines was formed right here. And so if it's for example, if it were to make the same move exactly as the dot-com bubble right here, then it would be a percentage pullback, a pullback of around 71.61, 71.61%. So it would be here. Look at guys, it would be from this top to here, around that 71.51% pullback right there. That would be the move. So, and why is this one is 71% and this one is 80%? Because when you pull back from a lower price, like from here to here, this is an 80%. But if you have that same pullback but with a higher price, this one was around that $4,820 with 40 cents. And when you have that same pullback, but this time from $16,835 with 69 cents, then you get that 71%. Then you get that 61% pullback. That's 71.61% pullback. Let's see right here, 71.61%. Okay, and so if it were to play out exactly as before, that would be the move. But it would be weird if it does that, but it can do that. Okay, but I'm personally not. I'm anticipating that that's not going to happen exactly like this, but it will have a very harsh pullback, very harsh pullback. So let's see right here, guys. So as you can see here, guys, the scenario I'm seeing that can happen will be, let's see here, guys. I'm expecting at least a 50% move because pullback, because first you have this massive from this 2008. This has gone up like a straight line like this, and it has to have at least a 50% pullback before it can go higher, guys. That's how it works. As you're seeing right here, this is very similar. If you go here, boom, 80%. And if you go here, you have boom, potentially not 80%, not that drastically, because this move was more parabolic. This was a quicker uptrend. The quicker it goes, the quicker it goes down. But this one, even if it's going a little bit too fast, even if it's going up to a little bit too fast, I'm not seeing this going 80%, but at least to that minimum 50%. I want that 40% to 50%, and then the maximum I'm seeing 80%. So it would be a 50% pullback in between with that 80%, between 50 and 80% pullback. That's what I'm personally anticipating. But at least that 50%. That's my scenario in that case, at least. Okay. And also, guys, when you're seeing a lot of depth in the system, like for example, right here, this was the C dump here, this massive V shape. That's insane. That's insane. So that move was based on depth and not value. And when you justify a price like this with with most of that movement not being value but with depth, then eventually the true value will have to be shown eventually, because when you have, that's where you get that overbought markets. You have a lot of depth, so you don't have the true value of what you're seeing in the charts, because it's depth. It's future purchase being put in now. So you take that future purchase and you put it right now. And when you have excessive amounts of future purchase, when you don't have the value to provide that amount of movement based on the depth you put in, then eventually it will have to come back to that reality, to the true value of what it's truly producing. That's where you see those huge pullbacks, because it's not real value, so it has to balance out in the real terms. So yeah, that's a summary of that. So, and personally, the only way this can keep going higher at this moment is the Fed out of nowhere comes up saying they're gonna print more money and they're going to invest money, and that's where I see this resistance being broken. It's already been broken, but when it retests this white line as new support, it will hold that and then continue going higher. If the Fed can, if the Fed if the Fed comes out of nowhere starting to print more money and also invest in the markets. That's the one scenario. The second one, if this price can go above the 0.78 break that resistance, hold this as support, as new support, then and start going higher. That's the only scenario where I'm seeing that this is a trend change. But in summary, unless the Fed doesn't doesn't print more money and starts investing, this will continue going down, and that's what history shows. It goes down, and as soon, in summary, this is how the markets work. You go up when the Fed prints more money and invests money, and when the Fed starts not printing more money and not investing, then you see pullbacks. That's the summary of it, in other words, most of the times. And so, as you can see right here, that's what is the, if you're looking for to sell, and because you're anticipating that market crash, which is not a guarantee, but due to the history and what I showed you before, it's mostly going to happen. But if you're looking to exit the market before that massive market crash, right now this is one of those opportunities. Remember, this is not financial advice, but I'm telling you what the charts I'm saying using the past, because right now the price is between this 0.5 and this 0.618 and this 0.65 Fibonacci retracement, which is a very good place to sell before having that lower low because of the dead cat bounce strategy. If you're anticipating a stock market crash, then this is a good time to exit if you're looking to exit. If not, hey, no worries. You can keep buying if you would like to. Remember, this is not financial advice. I'm just telling you what I'm seeing in the charts and recommending based on what I'm seeing in the charts, but it's not financial advice. I'm not telling you what to do. I'm just showing you and showing you the facts and what I'm seeing here, and I'm also telling you my perspective and my opinion on this. And so this is what is happening at the moment at the Nasdaq. And also, guys, I want to show you guys this for example. Let's see here, Shmita economic events. So you see right here how Shmita end of US calendar cycle spooks markets. So you see here that Shmita, the last year of a 7-year cycle in the Jewish calendar, has several times in the past brought immense financial hardships to the world. The biggest Wall Street crash, wait a second here, okay. The biggest Wall Street crash of 1987 happened during Shmita, and so did the bond market carnage of 1994. The 9/11 terror attack happened a day after Shmita in 2001, and Lenham Brothers filed for bankruptcy, and the subsequent 777-point fall in Dow Jones in 2008 also happened around Shmita. It's very consistent, guys. And those are various events that happen during those times. And also, we're in middle of a 50-year cycle, which is Jubilee. That's another massive thing. That's a very serious thing. And usually during those times, that's another cycle where big things happen. Also, we can search it here. I'm gonna verify that which specific events. So let's see, Jubilee 50-year cycle events. Let's see here, guys. Okay. Oh, look at that. Okay. Let's see here. Sabbatical years. Let's see here, guys. What it says here in summary. The custom letting the land rest in each 7 year was an important tenet of Jewish law. Let's see here. And the sabbatical year, the Jubilee year. Some ancient sources tend to indicate that the late Second Temple practice of observing the 7 years sprang from an earlier practice of celebrating a 50-year cycle. It seems that after 7 sets of sabbatical years had been celebrated, each 50-year called the Jubilee was also celebrated. The more primal practice of celebrating 7 sets of 7 years on a Jubilee year is described in the biblical text as follows. Let's see here, events that happened during those times. Okay, let's see what big events. So the last one, if we go to the Jubilee cycles, 49 years in length, you can see here, guys, that the last one, based on the charts, I'm going to show you guys. I'm going to use the S&P 500 because it has a lot of time in the market also. Let's see here. I'm going to show you just a second. Okay. Wow. Massive. So funny. Okay. Okay, let's see here. So 49 years ago. Let's see. 22. Just a second here. It will be 22. And then another 42. It would be around that 1973 era, which is here. Wow. Look at this, guys. So it was around here. This was the Jubilee massive dumpage around that 1972 to that 1973 range. And this one, wow, it was harsh. It was around, let's see here. And there, it's here. Here to here. There. Yes, there. Boom. I'm gonna show you guys. It was around a pullback. Let's see here, from here to here. And 50%. Wow, it almost matched the same 49%, like the 49 year. To the dot. Oh my gosh, that's insane. Come on. Wow, that would make a lot of sense also. 50% pullback. That's another piece of information we can use right there. This, let's see here. This S&P 500. Let's see the dead cat bounce scenario here. From here to here, let's see the S&P 500 here. And look at that. Pullback and boom. Very good time to sell if you're looking for continuation to the downside, a lower low than this one right here would be around here. And if you're also expecting a market crash, yeah, if you're looking for a lower low right here, then this would be a good time to sell. Not financial advice. Or if you're looking for a market crash, then this is a good time to sell because of the market crash. It will go lower there. And let's see, guys. So using the NASDAQ, I'm going to show you here. At this moment, the price from these previous all-time highs was down from this swing high to this swing low, around that 34% pullback. And at this moment, because of the recovery, then this has already recovered. I'm gonna show you from here to here. It will be a 19% pullback. But remember, guys, the Feds printed almost 50% of almost the whole US dollar market in less than a year. And the US dollar goes for more than 50 years. So that inflation has to eventually happen. Okay, that was saved. That was saved for momentarily because of the Fed printing money right here, but eventually that will have to eventually have its effect eventually on the markets. Remember, guys, when new money comes out, which is printed, that money goes into the best investments, which would be the stock market, got the housing market price. You got the stock market, the housing market, watches, cryptocurrencies, and usually it goes to the best investments. And when the Fed stop printing more money, then eventually to cover those markets, people start selling. That's how it works. That's how it works most of the times. And yeah, guys, that's what I'm seeing right now, looking at the Nasdaq and going into the Bitcoin price right here. Let's see here. So it will make, if the Nasdaq pulls back around 50%, which the reason why I covered the Nasdaq and the stock market is because the Bitcoin price is very correlated with the S&P 500, and it is more correlated with the Nasdaq than the S&P 500 because of the technology stock, which will be the Nasdaq, the 100, Nasdaq 100. And if the Nasdaq pulls back around 50%, then expect for the Bitcoin price to go around at least that $14,000 to that $15,000 level. That's what I'm personally anticipating because of different reasonings. You can check out my previous stock market crash video, which I'm going to leave in the description below. And I go into the S&P 500 and I did the same thing I did the same thing I did in this video, but with the S&P 500 in that case. And so, and I also go into the Dow Jones also in that video. Also, guys, you have September. It's very interesting that the Shmitah starts on September because September has the prefix of September 7, October as octagon, 8 sides, and then you have November as 9, November, December as decimal dies, and yeah, that's a true calendar year. That's why we have the Shmitas during those times specifically, because that's the calendar of the Jewish year in that case. So that's why it happens, guys. So yeah, guys, so that's why this is what I'm seeing, guys. And if you enjoy this YouTube video, guys, leave a like, comment, and share this YouTube video with your friends. Also, subscribe to my YouTube channel, Crypto Solutions, if you haven't subscribed yet, guys. And also, guys, click the bell notifications to stay ahead in the cryptocurrency market using my cryptocurrency technical analysis videos, and also when I post stock market videos, which is not that common, but I only post usually when important things happen. I don't like posting almost every single day when the market is doing almost the same. I like to update, I like to post when something different happens or something truly important happens, because it's just, that's how it works, even if the algorithm doesn't like that, the YouTube algorithm. But I do it because I want to help, and I am not controlled by the YouTube algorithm. I can use it if I want to, but in these cases, I enjoy helping people by providing this information which most people don't know about. And this way you can prepare yourselves for eventually what's going to happen and not get surprised by it, and be prepared for it and use it to your advantage. Because remember, almost everything is probabilities. You have to verify which things are more probable, because everything is possible, but the most likely scenarios most of the times happen. So you have to identify the patterns that happens most of the times and use it to your advantage and adjust to that, so you can have a better future and a better life. And this applies to almost everything, anything. So yeah. Also, guys, Also, you can support my YouTube channel by clicking in the Patreon link in the description below, where you can get an elite VIP crypto investor membership, where you can get an immediate short-term buying opportunities, immediate short-term selling opportunities, live weekly long-term cryptocurrency price updates, Bitcoin tops and Bitcoin bottoms with certainty in the short term and in the long term. Also live updates, my buying targets, my selling targets. And thank you so much for watching this YouTube video, guys. Have a nice day, guys. Take care, guys, and peace out, guys.